Good morning from San Francisco. My name is Andy Kelly. I am a managing director at JP Morgan, where I'm a part of the team of the early stage tech lending practice. I am delighted to be hosting the panel today with two esteemed colleagues on what growth stage investors look for in marketplace investments. I have to my left here on the Zoom, I have Maya Noeth, who leads Accel's growth consumer internet practice, and Carolina Brochado, who is at EQT Partners in London and also does growth stage investments. I'm delighted to have you both here. Thanks so much for joining. And thanks for taking the time. This should be a good session. There was the conversation yesterday, of course, for what early stage investors look for in marketplace investments. And so we're going to take it a little bit later and get your thoughts on sort of as companies and marketplaces move along, what becomes attracting, to you, and what do you think about when you're making investments? And so one of the questions I'd love to start with is, are there tipping points that you both look for that really signal that, a marketplace has made it far enough that, the capital that you would put to work at the growth stage, is appropriate, makes sense, and that has enough traction? So, and I guess the related question is, what really gives you conviction that you found the right marketplace and it's doing the right thing? So maybe Maya, if we could start with you, that would be great.
Yeah, of course. So I think, an easy filter is accelerating GMV growth, especially as a company gets to scale. I think just very simplistically, that points to the fact that the marketplace is actually facilitating connections and successful transactions. But really, like a level below that and beyond that, we also analyze the conversion funnel from top to bottom. And different companies will have different metrics that matter. For example, back in 2014, I invested in Rover, which is the pet sitting marketplace. And for them, we looked at the top of funnel traffic, and then the two main conversion metrics as you went down the funnel that were important were the search to request rate and the request to book rate. So search to request was, someone going onto the platform and looking for a pet sitter and then hitting the request button to connect with them. And then further down the funnel was if the pet sitter, agreed to work with them, and that was the request to book rate. So seeing those two metrics in particular improve over time was an important validation point. And there's no, right percentage for what each of those should be. And again, it will depend on, your company and what you're facilitating in terms of, connections. But even things just like evaluating like the drop off point within the funnel as you go further down helps you to just ask the right questions around, what is it about the product or the experience that needs to be improved? And so we really spend a lot of time looking at that conversion funnel, and oftentimes you can glean a lot of really interesting takeaways from the business from that.
Great. Carolina, how about you?
Yeah, no, I fully agree with everything that was said. So trying to think of, how to say something different, but I think engagement in any way that you can grasp engagement with the product. And of course, some of the most beautiful marketplaces are fragmented on both sides. And so making sure that both sides of the marketplace are engaging in ways that become more predictable and more under your control. So in certain kind of marketplaces, one of the investments I did during my time at Atomical was in this company called Recce that is connecting restaurants to their suppliers. And what you could see is if someone used Recce X times for X orders, that meant that their retention was incredible. They basically wouldn't churn. And so then you can use your growth capital, right, or your capital to say, how do you accelerate someone getting to that number of orders so that they're retained for a long time? For example, another example of one of EQT companies, which is the food delivery marketplace Volt, is on the driver throughput, right? And how many number of restaurants do you have to have on? How many number of drivers and frequency of usage do you need to have so that the algorithm can get to a throughput that obviously then has lots of effects in both the customer experience, because it becomes 30 minutes or less for delivery, but also in your unit economics, right, which is very critical. So I think those are a few. The engagement, whatever metric that may be, depending on the product, is always something that typically you can see early on, but then at growth stage you can really accelerate and control if you know what they are, what the parameters are.
Great. And one question I had that I was curious to get your thoughts on is, do you view the capital that you put to work as ideally like leading into the tipping points, or are you really wanting to accelerate out? And Carolina, you may have just sort of answered this a bit, but like how should the audience think about sort of where your capital really appropriately gets applied, like leading in or pushing past and really then speeding it on from there? And Maya, you want to take a stab at that one, and then we'll.
Sure. Yeah. So we're at Accel in an interesting and potentially unique position because we got our start 40 years ago investing at the seed and Series A stage, and then we launched our separate growth fund about 12 or 13 years ago now. So we're actually quite accustomed to investing across multiple stages of a company's growth or evolution, from the earliest stages to late stage growth. So we can actually be pretty flexible. We also take a thesis-driven approach to investing, which basically allows us to actively catalyze transactions in businesses where we've proactively identified them being as interesting based on our sector work. So that upfront work that we've done allows us to have conviction to, as you put it, Andy, lead into the tipping points, where otherwise we might not have understood at those early stages, had we not done the deep sector work specifically in this space. I mean, one example is, we spent a lot of time looking at the on-demand food delivery space, several years back now, probably 7-8 years ago now. And one of the most important metrics that we looked at there, because we were very focused on unit economics working, is orders delivered per hour. That is a very important metric that will tell you whether or not a business is likely to be contribution margin positive in their markets over time, because density really matters when you're doing delivery. And so because we did a lot of work in that space and talked to everyone in the space, sort of gathered the data on, what is a typical order delivered per hour metric for the various types of food delivery businesses, we were able to sort of triangulate on what's high versus what's low and how does that impact your unit economics going down the line, and ultimately help you to reach profitability. And so having done that upfront work, when we talked to GoPuff, which is one of our portfolio companies at Accel, it was, one of my very first questions to the company was, talk to me about, your delivery density and your network and your orders delivered per hour and how that works for you guys. And their number was significantly higher than the other folks that we had been speaking to in the past. And so that allowed us to gain some early conviction in the business and really laser in on kind of the key questions that matter, and allowed us to get to an answer whether or not we wanted to move forward with the business and catalyze something, sooner than other folks might have. So that's actually that thesis work and that sector specific work at a level of detail a little bit deeper is what has allowed us to get conviction to lead into the tipping points.
That's great. Carolina, same for EQT. It's a little bit of a different fund structure than Accel. So do you guys think of it the same way, or are there sort of, nuances that are a little bit different in terms of how you think about where the capital gets applied?
Yeah, look, I think the interesting thing about EQT is we have a ventures fund, a growth fund, which is where I sit, and a private equity business. And so we have the benefit of sort of seeing companies across the board at different stages, all the way from seed to very mature, incumbents that maybe our startups are trying to disrupt in some cases. But I fully agree that being thesis driven with how you approach marketplaces and seeing how these marketplaces evolve over time allows you to be way more focused, right? When you see something new. So again, I'm fully aligned on that. What I'd add, just to add sort of a different dynamic, is what is really, and you see this in Europe a lot, right? Because in Europe, you have to be global from day one if you want to be a large marketplace, because you have to immediately go outside of your own country because it's likely going to be too small, which is perhaps a different dynamic than the US. And so what is beautiful to see here, and you see this sometimes, are the J curves, right? Where they start in one market and they're able to figure out that market, and you can see the contribution margin going positive, and you can see how deep the investment curve is. And then what's really exciting is when you pick the right team, the right execution, and they're able to replicate that playbook in multiple markets, right? And I think as a growth investor, that's what you love to do. You find something that's working, and then you can replicate that across. And of course, every market isn't going to work, but there's a lot of complexity in that, and there's a lot of execution shots that go in that. And I think that's one of the really exciting things about investing in Europe is you do have to back teams and models that can, from day one, almost be thinking about how am I going to go international.
That's great. Thank you for raising that. And one of the questions I was going to ask you both is, how you wrestle with, and fair enough, as companies get to you and you both have, the advantage of seeing some move along through your portfolio companies and the work that you do on sectors and thesis. But one of the questions I was going to ask was, how do you think about, not boiling an ocean too quickly, where you haven't really figured out your unit economics, and yet you start moving across into other either geographies. In the US could be other cities, and in Europe it's other countries. So that's helpful to know, is sort of, how do you think about, have they really gotten it right before you want to put the capital to work to have them go broadly? So like Maya, at your stage, do you really feel like you see companies that have gotten their unit economics sort of appropriately worked out, and now it's truly a function of let's add more capital to the growth?
Yeah, and maybe to a fault, my bias has always been unit economics really matter. I believe very strongly in that as an investor. So you don't have to have the most perfect unit economics when we're investing, but there has to be, in my opinion, some progression that you can demonstrate and some path to profitability in the at least medium term, to show that if you are adding fuel to the flames, like it's not going to just be this concept of profitless prosperity, right? Like, to me, it doesn't matter so much if you can show a huge GMV number if you're never going to be profitable, right? Like, you have to show, in my opinion, that progression to how your unit economics eventually pencil out and how you can create a profitable enterprise. And so to me, that's pretty important.
Great. And Caroline, I've dropped you there briefly, but it was just sort of that you raised a good point about sort of the distinction of, in Europe, you really have to make sure your unit economics are working in a small market, but then pretty quickly move sideways and across, to gain scale. And so wanted to, get your thoughts on, does the capital, do you really need to make sure it works in one country before you want to put the capital to work to expand into other countries across Europe and then, to the US potentially?
Yeah, that's right. No, I really agree with what Maya said, and some of my entrepreneurs would I think chuckle, because I say this in board meetings often. I think it's, in certain kinds of marketplaces, it's very easy to buy GMV, and all you're doing is subsidizing people to use your product, which basically you're giving something for free. So I think having a really good sense of, and again, it doesn't have to be fully baked, it often isn't, but of the direction of travel, and what do you have to control the direction of travel, and what's important to track, and then being very data driven and analytical is really key. And I also think focus is super key. So when I talk to teams and they're about to, go on some sort of Marco Polo strategy, 15 countries all at the same time, that makes me very nervous. I would much rather, see, 5 with a lot of focus, and then, go for the next 5 or 10 or whatever it is once things are fully baked. So I think focus is really important. And of course you have to move fast because there's a lot of money, there's a lot of competition, right? The barriers to entry at first are relatively low, but you have to be fast, but you also have to be, thoughtful and methodical.
Great. Just a note for the audience, I will leave some time for questions at the back half of this half hour. So if you have them, please let us know. But in the meantime, both of you are at growth stage firms, or or your funds that you specifically sit in, and Carolina, you were at SoftBank before joining EQT this past June. Is too much capital a problem, or potentially a problem for some of the companies that you look at? And you've alluded to it again, Carolina, with sort of how you think about some of these, but like, how much do you weigh that question of, is this capital going to cause downstream effects that are not the ones that are intended?
Yeah, I can take that first. I think so. I think too much capital can make teams complacent, and it can also mask issues within organizations. So if you think about some of these businesses, they find product market fit, which is fantastic with whatever product, and then these organizations start scaling very quickly, and this puts a lot of pressure on very simple things that are very hard to do, like building culture or building the right scalable organization to tackle these different markets and to tackle these different problems. And if you continue to raise money, then there's no forcing function to help you, think really hard and think really deep on what you would optimize and how you would focus. Again, I think the capital question, does force focus. So yeah, I think I've seen it in some cases where, yeah, it does cause complacency and lack of focus.
Okay.
Yeah, I would agree with that 100%. I think, in general, my observation is the leaner the team and the less capital they've raised, the more judicious they are with the spend, which makes sense if you think about it. It's much more of a precious resource when there isn't so much. So yeah, I think just in general, when you raise too much capital, it's too easy to worry less about the ROI that's associated with the spend. And I think, in general at Accel, we've been very successful backing businesses who historically have been bootstrapped, but reached, pretty large scale just by being lean and remaining focused and judicious with their spend. Companies like Qualtrics, 1Password, Tenable, companies like that. It's sometimes investing is about pattern recognition, or a lot of times it is. And, those companies have really proven that, the leaner you are, the more judicious you are with your spend, in general, that the better the decisions that you are, forced to make or put in a position to make.
Yeah.
I guess the caveat just being, that you always want to give yourself a nice, runway so that you aren't constantly raising capital, because that can be a distraction, or, very topically, if the world sort of comes to a halt and comes crashing down on you due to unforeseen circumstances like a global pandemic, you want to have built in a comfortable cushion. So.
Yeah. A question that came in from the audience on managed marketplaces. Do you think of those differently, where potentially you have a higher average sale price? Are there particular KPIs or metrics that you look for that are a little bit different, because it's not like a free for all kind of marketplace and you've got some managed to it? Like, do you look at those differently? How do you think about them? What are kind of the key metrics that in a managed marketplace that moves a little bit differently you'd want to see?
I can go for it. I think so. I think there's a higher bar on the execution just as a whole. And more focus on some of the data, the unit economics, and the overall health of the marketplace, and the team, right? And how that team is scaling and professionalizing, because those are going to be much more complex businesses to operate. And I think, at least in my experience, it's really about the teams managing that ultimately makes that successful.
Yeah, I agree spot on with what Carolina said. I think the management team and the broader team in general just plays more hands-on role, obviously, in what's happening in the marketplace. And so team is always critically important, the number one most important thing, but really understanding how they articulate the strategy for how they manage the marketplace, and all the various downstream effects of that is really important. Just making sure you're aligned with how they do so.
Great. Now, obviously, we've seen, Maya, you mentioned this, thinking about food delivery 7 or 8 years ago, and we've seen, a continued sort of evolution of marketplaces. Are there sort of current sectors in the last year or so that you both have found particularly compelling that you have maybe been looking at, whether or not you've found one that has been the right fit for your respective firms? But are there areas that you sort of find particularly appealing right now?
I'm happy to start with that. I mean, we look at everything kind of under the sun in terms of B2C, but we have as I mentioned, a thesis-driven sector approach or subvertical approach, however you want to think of it. So I mentioned food delivery to begin with. It's one where we've had to be very patient because obviously food delivery is kind of it's not going away, right? It's the way of the future. It's only growing in popularity. But as I mentioned, historically, we've always had an issue with kind of this pursuit of raw GMV, grow GMV as fast as you can, but markets remain sort of unprofitable for the foreseeable future, at least at the time. And so, we've had to be very patient and try to take a differentiated approach with the types of companies that we've looked at. And so I think this time 2 years ago in 2018, we made our first investment in GoPuff. And that was a business that had a fundamentally different model from the on-demand, the other on-demand food delivery space businesses. And GoPuff, for folks who don't know, they are disrupting the convenience store delivery space, aiming to bring you kind of all your everyday needs to your home in 20 minutes or less. Which is significantly faster than a lot of the other competitors out there. And they had a different model in the sense that, they actually have these very centrally located, small footprint, kind of like micro facilities. So they own the inventory, right? And they are delivering from these like very hyper-located warehouses, for lack of a better term, to folks. And that cutting out kind of the wait time at the restaurant, for example, is a huge lever in increasing orders delivered per hour, which is the metric that I mentioned earlier. And so that's why we were able, it's a key component of why we were able to get super excited about the business because, they demonstrated, far superior unit economics than some of the other businesses that we had looked at. So the point of all this just being like, food delivery was really exciting, but sometimes you have to be patient in your approach to selecting, the horse that you want to back in the space. So that was one. We also are spending a lot of time in the, I don't know what you want to call it, whether it's health and wellness or healthcare space, looking at marketplaces that connect folks to either mental health services or just generally like primary care services, because that's also an area that, is historically, there are a lot of issues around supply and demand. The supply is outstripped by demand. Folks have a hard time finding doctors. The whole experience is really poor for the payers, the providers, and the patients. So we're spending a lot of time in that space, better understanding ways to make access and affordability just better for everyone in the space.
Great. Carolina.
Yeah, Maya hit the nail on the head with the second one. I think a few years ago, I sort of shifted my focus from B2C marketplaces to B2B and spent a lot of time in health and wellness. And a couple of the companies that I've invested in along the way, one is a company called Hinge Health, which sells a musculoskeletal digital care solution. So if you have knee pain, back pain, etc., it sells it through your employer as a benefit to employees. So it's free to the employee. They get a little kit. They do their physio, right? So it's democratizing access to this. It's increasing the quality of the care that you get. And it's also, it's free for the patient and it's a benefit for the employer. And the ROI is very clear because people go on to be less depressed, buy less opioids, do less surgery, which is obviously incredibly costly. So that's been a big theme for me. Another business I invested in is a company called GymPass, which, provides gym or physical activity access to employees to benefit through the employer. So it's actually multiple constituents. It's the gym, the employer, and the employees. sort of like a three-sided marketplace with a SaaS business model. And, both these businesses have been very successful in their expansion and, and how they've been able to replicate. In Gympass's example, I invested when it was only a Brazilian business. I'm Brazilian originally. And then they expanded into Europe, and now they're in the US. And again, the curves, the thinking global, the replicating the model, all of that, you kind of really saw that in action.
Great. We are up against the bottom half of the half hour. Thank you both, Maya and Carolina, for joining. This is terrific. I think helpful. There were more questions piling up, which we sadly won't get to, but I appreciate you both taking the time and sharing thoughts on what you look for as marketplaces really hit scale and move on. So thank you both for joining. I appreciate it.
Thanks, Andy.
Thank you so much. Bye.